Hello, this is Bill Scheid from Applied Finance Research, and in this video we'll be taking a look at research by R.J. Hixson on the 4 types of crises. So the research that we're going to talk about here comes from R.J. Hixson, who is the former vice president of the Van Tharp Institute and the co-author of the book he and I are writing together called Smart is Not Enough. RJ is also the founder of the Growth Guardian newsletter, in which he uses proprietary monthly system signals that I created for him and his subscribers. It's an excellent system, and RJ's newsletters are very informative. I read them and learn things all the time. If you want more information on his newsletter, the website is www.gginvestor.com. Now, for the research that we're going to look at, RJ used 2 primary sources. The first is Ray Dalio's book, How Countries Go Broke, and the second is information from the Committee for Responsible Federal Budget. Now, from those 2 sources, he was able to create a simple and effective way of categorizing market crises. So we have 2 axes, basically 2 simple spectrums. The first is what's happening in the monetary world, and it runs from inflationary to deflationary. So on the inflationary side, governments print money or repress interest rates, currencies weaken, and prices climb. On the deflationary side, typically credit contracts, asset prices fall, and market liquidity tends to dry up. Now, the second major spectrum here measures speed, and we have acute versus gradual. So an acute crisis, this shocks the markets and it forces very fast price adjustments. A gradual crisis, this is the kind of thing that erodes purchase power or growth over a period of years, sometimes even decades. So fast crises, these are the ones that feel dramatic and very volatile. Slow crises, these are the ones that feel kind of deceptive because they don't always make the headlines, even though they can have very serious impacts. So when we look at the quadrants here, in the bottom left, we have acute deflationary crises. So these happen when investors lose confidence and credit tightens up and asset prices fall very quickly. So an example would be the great financial crisis of 2008. So Lehman Brothers collapsed, and then within a matter of weeks, the whole global financial system just about seized up. Banks stopped lending, credit froze, and of course we all know the stock market plummeted. Now in the upper left, here is where we have acute inflationary crises. This usually comes from governments trying to manage debt burdens by creating too much money, or sometimes using repressive capital controls, or sometimes doing both at the same time. So an example here would be Weimar Germany in the 1920s when inflation was just through the roof. Now, in the upper right, we have a gradual inflation crisis. So we could use the US as an example. The 15 years from 1965 to 1980. For example, like in 1965, inflation was around 2%. Then by 1980, it hit around 13%. The S&P during this period returned an annualized return, compound annual growth rate of about 1.5% per year for those 15 years. But when adjusted for inflation, the S&P lost about 40% of its purchasing power. So that's an excellent example of gradual inflationary erosion. Now, in the bottom right, this is where we have a gradual deflationary crisis. So no collapse, no dramatic headlines. Instead, we tend to see slower growth and declining economic performance year after year. Japan has essentially lived here since the 1990s. Debt never exploded, it has just slowly weighed everything down. And it's also important to note on these axes that a crisis can start heading in one direction and then change and go in another direction. So I think the question is, where are we now and what kind of crisis will be the next one? Well, as for where we are now, at the time that I'm making this video, I would say over the last year or two, we have been close to the center of the grid, although perhaps leaning a bit slightly towards the inflationary side. I would say signs of strains are starting to show. US debt is continuing to grow at an incredible speed. Stock valuations are near historic highs. Job growth hasn't been very robust. It could be the case that we move towards a gradual inflationary crisis in terms of what's coming next, but I can also see a case where if confidence in the US Treasury markets were to suddenly break, then we could also move towards an acute deflationary crisis. Where we go next is really anybody's guess, and the purpose here, in fact, isn't to make a prediction. It's just to get a sense of what could be possible and to help build a framework for understanding. So the context here is really more about scenario planning. It's preparation instead of prediction. And that, to me, helps us be prepared to execute our system rules, and it also reduces cognitive and emotional load when the next crisis hit. It's not a question of if there will be another crisis. It's really just a question of when and what type. And actually, RJ made a very interesting point that I think is worth closing with here. In the newsletter recently, he said that the real risk actually isn't even the crisis itself. The real risk is not being prepared with robust volatility adaptive systems. And I couldn't agree more. RJ, thank you very much for the fantastic research, very insightful and very helpful. This is Bill Scheid from Applied Finance Research. Thank you very much for watching and happy investing.